So, very good evening, all the students and all the attendees.
Let me start the presentation. Think back to your first day as an article. You walked into the office with big dreams of handling high profile audit. But instead, your senior handed you a thick file and said, "Welcome to the world of bank branch audit, and start with this checklist." And that's where the real learning begins. Good evening, everyone. I am Sanskruti, and along with my colleague Atharva, we are articles at Khandelwal Jain and Company. Today, we will be discussing bank branch audits, a topic that is not just crucial for our profession but also plays a key role in ensuring the stability of the banking sector. At CA articles, we often hear about statutory audits, tax audits, and internal audits. But bank branch audits are an entirely different ballgame. They require a mix of technical knowledge, regulatory compliance, and practical judgment. And most importantly, they test our ability to detect financial misstatements and frauds. Before we move forward, let me ask you this. What comes to your mind when you hear the word bank audit? Please drop your answers in the chat box. So let me explain. It is indeed about compliance with financial regulations where meticulous verification of transactions is conducted to assess potential risks and ensure transparency in financial reporting. Before we dive in, let's take a look at today's agenda. We will begin by an understanding of the bank structure and basics, covering the foundation of bank branch audits. Next, we will discuss planning and preparation, including the initial requirement list and the regulatory framework. We will then explore the financial statements, understanding the core reports that form the basis of the audit. A session on key concepts will ensure familiarity with fundamental auditing and terminology. Our focus will then shift to the core audit areas like advances, IRAC norms, NPA classification, deposits, GL, and PL accounts. We will also cover LFAR and compliance reporting, discussing the long form audit report and other compliance obligations. Finally, we will go through audit finalization and closure, learning how to report findings and ensure completeness. Lastly, we will conclude with key takeaways and Q&A session. So feel free to jot down any questions along the way. Let's move toward the next slide. Imagine you're reading the news and you see two headlines. Bank sanctioned 1,000 crore loan to a corporate giant and local branch approves rupees 5 lakh personal loan in 10 minutes. Both are banking decisions. But have you ever wondered who makes these calls? Banks don't function as a single unit. Instead, they operate through a structured system. The head office, the zonal and regional office, and the branch level. So let's understand how a bank operates. Let's look at the branch network first. Your local branch handles deposits, loans, and transactions. It cannot function on its own and follow directives from higher offices. The branch manager oversees operations supported by relationship managers, you can see on the screen, loan officers, and clerical staff. With countless of transactions daily, audit ensure accuracy and control. As multiple branches operate within a region, a higher level of supervision is always needed. This is where the regional offices come into the picture. The zonal and regional office. A branch reports to a regional office led by a regional manager which supervises multiple branches and ensures they follow policies. When the network expands further, a zonal manager monitors multiple regions before escalating matters to the head office. And at the highest level, we have the head office, also known as The corporate office. This office formulates policies and ensures compliance. And the key officials include general managers, chief general managers, executive directors, and at the top we have C and MD, that is chairman and managing director, who leads the bank and ensures adherence to the RBI regulations. So in brief, banks operate in a structural hierarchy. Branch serves customers, regional and zonal offices oversee operations, and head office set policies. Let's proceed to the next topic. Imagine a large bank with thousands of branches spread across the country. Some branches handle personal saving accounts, while others process loans worth hundreds of crores. Now think about this. Can we audit these massive institutions using a single approach? The answer is clear no. And that's exactly why the banking audit structure has two distinct levels, SCAs and SBAs. Let's understand what creates difference between statutory central auditors, SCAs, and statutory branch auditors, SBAs. Statutory central auditors audit bank as a whole, including its head office and major branches. They consolidate reports from SBAs, ensure compliance with regulatory requirements, and assess the overall financial health of the bank. Their final audit report is submitted to the bank's BOD, Board of Directors, and the Reserve Bank of India. On the other hand, SBAs audit individual bank branches. They review financial records, assess loan classification, and ensure compliance with RBI guidelines. Once their audit is complete, they submit their report to the statutory central auditors, including the LFAR long form audit report, NPA details, and tax audit findings. Moving forward, let's explore the next section. Imagine walking into a branch, not as a customer, but as someone responsible for ensuring its financial health. Every transaction, every loan, and every cash movement, it all needs to be checked. But where do you start? A bank branch is more than just a place where deposits and withdrawals happen. It's where loans are disbursed and regulatory compliance is tested. To ensure that everything runs smoothly, a structured approach is necessary. Today, we will go through the step-by-step process of planning. Let's see those steps. So before starting the audit, it is very important to understand how the branch operates, including its loan portfolio and customer base. This helps in identifying key focus areas and ensuring a smooth audit process. The next step is to obtain and review essential documents such as last year's audited financial statements, audit reports, LFAR, loan balancing file, also known as advances dump, and the bank's closing circular, also RBI circulars, past concurrent or internal audit reports. And these documents provide insights into past observations and help assess the financial health of a branch. Now, not all areas require special attention, but it is very crucial to focus on NPAs, large advances, cash transactions, and potential fraud indicators. Identifying these areas early allows a more effective audit. So, final and the last step is communicating with the branch management is very essential. Issuing the initial requirement list ensures that all necessary information is collected, making the audit process more efficient and well structured. So, with that covered, let's shift our focus to the initial requirement list.
So, good afternoon, everybody. First of all, thank you very much for coming, for joining in online and in physical. We have a good strength of almost 15 articles, 15 to 20 articles from Kirtane and Pandit who've joined us, and we have almost 115 plus attendees online. The idea of having today's presentation is equipping all the articles with a very basic knowledge of bank audit, since we very firmly believe that articles are the ears and eyes of the partners and the managers who are on field for conducting branch audit of respective banks. uh, Sanskruti and Atharva they are the second year articles with our firm, and they've made this presentation based on some of the very basic experiences that they've had and some basic knowledge which we feel is good for articles to know whenever they go on field for branch audits. So she's explained briefly how a branch audit is different from that of a bank audit. What happens at bank audit is being done at central level, is being looked after by statutory central auditors, whereas for branches there are branch auditors who are being appointed. So this presentation primarily focuses on the branch audit level. She's also started with discussing the planning and preparation, that how you need to understand the banking environment before getting into any branch audit. How you need, what are the basic key documents which you need to obtain, which you need to ask from various branches, so that you can start your work seamlessly. And also, what are the high risk areas which you need to focus on, and also what are the kind of initial requirement list that we'll just go through right now. So Sanskrit will explain when you go to the branch, what are the basic requirements, what are the basic documents that you should ask from the branch people, right? So over to you, Sanskrit.
Thank you, Rishikesh sir. So with that covered, let's shift our focus to the initial requirement list. Here is the initial requirement list. So a bank audit begins long before the first transaction is examined. It starts with gathering the initial requirement list. Just like a blueprint guides the construction of a building, the IRL provides auditors with a structured view of bank financial and operational health. Now, as auditors, we need to review all the returns, including summary and granular, to understand the financial data submitted to the regulators. Next, we must verify the balancing report, profit and loss, and balance sheet to ensure financial accuracy. Moving forward, checking previous period signed financial and auditor observations helps track unresolved discrepancies. At this stage, we need to analyze cash credit, overdraft, and loan balancing file to verify proper utilization and reconciliation. Now, examining the system-generated NPA report, including opening report and closing report, ensures correct loan classification. Next, we should assess details of any fraud reported or noticed to evaluate fraud risks. A review of list of all advances with appropriate details helps us to understand lending exposure. Next, analyzing the list of alerts generated by early warning signals helps identify potential repayment risks. Next, exception reports. Moving ahead, reviewing details of new accounts opened with KYC documents ensures regulatory compliance. Next, verifying the list of new loan sanctions during the period ensures adherence to policies. We must examine the latest internal or concurrent audit report to identify operational gaps. And finally, referring to the last year's LFAR helps assess recurring issues. So to conclude, a well-prepared initial requirement list sets the foundation for smooth and effective audit. Moving forward to the next slide.
So essentially, whenever you go to any particular branch, there are certain things that, as she's already mentioned, that you need to ask from the branch management. So things like list of all the returns. So at branch level, you won't have a complete set of financials. Of course, they'll have their GL and PL, that is their balance sheet and profit and loss account. But then at the same time, you need to ask them what was signed last year, what were your documents which are to be reviewed this time, including certificates. There are a lot of returns which you need to also audit. So all those documents of previous year first you need to ask them. Then there is something known as CCOD and loan balancing file. So more on that when she goes in our next slides. She'll be explaining what is a CC, what is an OD, what are various kinds of advances. Apart from that, there is something known as early warning system, which every bank is required to have, which is a mandate by RBI. So again, early warning system is something. If you refer the fraud circular which has been issued by RBI, there is a list of around 42 pointers which bank needs to identify as their early warning signs of any stress in the accounts. So we'll discuss more on that. Apart from that, you also need to focus on the new loans which have to be sanctioned. And before we go ahead, let me tell you, bank branch audit in itself is a massive topic. If you want to cover all the areas, I think it will take one full day seminar. But right now, we'll focus only on the critical areas, which is advances. So the entire presentation today's presentation is revolves around advances. So now she'll be explaining us regarding
Next. So, moving on.
the financials.
The financial
Financials
statements
of
of a bank. You want to understand a company's financial health. You look at its balance sheet and profit and loss account. But what about a bank? Is analyzing a bank's financials the same as analyzing a regular business? Not really. Unlike companies that sell products or services, banks deal directly with money through loans, deposits, and investments. That's why their financial statements are structured differently and require a unique approach to interpret. Today, we will break down how a bank's financial statements are structured and what they reveal. So, here is the format of financial statements of a bank. The balance sheet as per RBI prescribed schedules under the Banking Regulation Act 1949. Unlike manufacturing companies, where assets comprise machinery and stock, a bank's major assets primarily consist of loans given to customers, while its major liabilities mainly consist of customer deposits. Under liabilities, we have Schedule 1 for capital, covering paid up capital, authorized capital, and preference shares. Schedule 2 for reserves and surplus, consisting of statutory reserves, share premium, and retained earnings. Schedule 3 for deposits, which comprise current, savings, and fixed deposits. Schedule 4 for borrowings, including loans from RBI, interbank deposits, and foreign currency borrowings. Schedule 5 for other liabilities and provisions. Now let's move to the assets. Asset shows how a bank deploys its funds through lending and investments. Here, Schedule 6 for cash and balances with RBI, which includes vault cash and CRR balances. Next, Schedule 7, balances with banks and money market placements, covering interbank deposits and call money transactions. Moving on, Schedule 8 is for investments consisting of government securities, corporate bonds, and shares. Schedule 9 is for advances, which include retail loans, corporate loans, and NPAs. Schedule 10 is for fixed assets, comprising bank buildings, IT infrastructure, and ATMs. Finally, Schedule 11, other assets, which include accrued interest, deferred tax assets, and suspense accounts. And last schedule, Schedule 12, is for contingent liabilities. These are the off-balance sheet items that may become liabilities in the future. And understanding all of this helps to assess a bank's true financial health.
Right. So Sanskruti just mentioned that banks' financials are basically made in accordance with the third schedule, which is Form A of Banking Regulation Act. So many times people get confused whether is it Companies Act that is applicable. So for banks, there is a Banking Regulation Act which has to be complied with. At branch level, generally, you may not have to go through all the balance sheet items. It will typically consists of deposits, then other liabilities and provisions that you need to look at branch level. In terms of assets also, cash in bank is generally looked after at central level. Even balances with banks and investments, there is a separate treasury branch where all the investments are looked after. So what you will need to look after at branch level would be primarily your advances, then fixed assets, that too mostly immovable properties or immovable assets are looked after at central level. So mostly branch employees related fixed assets, those are the fixed assets which you'll have to look over here at branch level. And of course there'll be some other assets which will comprise of schedule 11. So these are 3 4 major areas, major schedules which you need to be aware of in terms of balance sheet of a branch. Sanskruti now will explain the P&L items of branch.
So now let's look at the profit and loss account of a bank. Here is the format of profit and loss account. This shows a bank how it earns, spends, and distributes its profits. It includes interest earned and forex. On the expense side, you can see the interest expended, Schedule 15, covers interest paid on deposits, while operating expense, Schedule 16, includes salaries, rent, and IT costs. Net profit is calculated after deducting all the provisions, and remaining amount is allocated to the appropriations, such as statutory reserves and dividends.
Now, why
So,
we are basically looking after the profit and loss and the balance sheet of branches. Now, whenever you receive your last year's returns or even the current year's returns, first thing when what you will do is just conduct a primary variance analysis. So अगर आप लोग को दिख रहा है कि advances in 1 year has increased compared to previous year, immediately you should have a you should it should click to you that you also need to see your interest income. Advances agar बढ़ गया है, so obviously interest income will also increase. Similarly, if the deposits in the branches have increased, you should understand that the interest expended will also be increased. So that variance you need to immediately know ki how you can link various schedules. Of course, even in PNL, not all appropriations and all will be looked after at branch level. It will be primarily up to schedule 16, that is your other expenses. Also, in other expenses, your vouching, your typical vouching is what you will be doing to verify.
next, let's dive into regulatory framework of the bank. So here is the regulatory framework. In banks, every entry from loan classification to foreign transaction is governed by strict regulatory frameworks set by RBI, SEBI, and international guidelines like Basel norms. Let's explore how these regulations impact a bank's financial statements and day-to-day operations. Now we will go through some key audit areas in banking, explain which regulations apply, and most importantly, where to refer to these rules when conducting audits. For loan classification and NPA, we refer to the RBI IRAC norms, which define asset classification and provisioning requirements, and these norms are issued by RBI. Next, the rules for income recognition, particularly for NPAs, are outlined in the RBI IRAC norms, which specify when interest income can be recognized and when it must be reversed. For capital adequacy, we refer to the Basel III guidelines and RBI capital adequacy framework, which define the minimum capital requirements and risk-weighted assets and composition of Tier 1 and Tier 2 capital. And these regulations issued by Basel Committee and RBI. Now, for fraud detection, a bank must follow RBI fraud reporting circular, which outlines the process of identifying, monitoring, and reporting fraud. For customer identification and anti-money laundering measures, banks must comply with the RBI KYC circulars and the Prevention of Money Laundering Act, PMLA. These regulations are issued by the RBI and Government of India to prevent financial crimes. And for LFAR, long form audit report, we refer to the RBI LFAR guidelines 2020, which provide a framework for auditors to assess loan quality, fraud detection, and operational risks in banks. Next, listed banks must comply with the SEBI listing Obligations and Disclosure Requirements, that is SEBI LODR, which sets standards for financial disclosures and corporate governance. And for foreign transaction, we must adhere to FEMA, which is Foreign Exchange Management Act 1999. So, in brief, a well informed auditor is a key safeguard against financial instability. So, moving on, let's go through the key resources every auditor must refer to during a bank audit. First, you can see on the screen is RBI website. You have to go to the notification or master circular for updated guidelines. Then you have to search for IRAC norms, LFR circular, or NPA classification for audit specific references. For example, if you need to check how a bank should classify NPAs, searching for RBI IRAC norms will provide the most current classification rules. Next, ICI website. It provides auditing standards and updates relevant to the bank audits. We need to check for announcement for recent regulatory changes and refer to auditing standards to ensure your audit process follows prescribed methodology. Next, bank's internal circulars and manuals. Every bank has its own policy documents, SOPs, and internal circulars, which outline operational procedures. You need to obtain it from the branch or head office during the audit and verify if the bank's internal policies align with the RBI norms. Next, Finance Ministry and SEBI websites. You can use this for updates on government policies affecting banks. Next, ICI publishes guidance notes on bank audits, which summarize key RBI and SEBI regulations. Here, refer to the ICI's guidance note on bank audits for a structured approach. So, to sum up, by using RBI, ICI, and bank-specific resources, auditors can confidently conduct audits with accuracy. For example, let's see RBI's website and how we can use it to find key banking regulation. Here is RBI's website. Notification sections, which is located on the home page. This section provides the latest updates on RBI's circulars, policies, and guidelines relevant to the bank audits. Here is the search bar. By entering keywords like IRAC norms, LFR circular, or Basel III, auditors can directly access the relevant RBI circulars and regulatory updates. Now, on the left-hand menu, you can see the master directions and master circulars, which include comprehensive RBI guidelines on banking operations, compliance, and audit requirements. By using this all features, auditors can efficiently access up-to-date regulatory information. Proceeding further.
So just to sum up now, what are the regulations that are, what is the regulatory framework which is applicable to banks? Like which is the regulator for the bank? RBI is the regulator. If it is a listed entity, then SEBI also comes into picture. Then apart from that, if the bank as a whole is offering various insurance products, in that case, to that extent, IRDA will also become applicable. But largely speaking, from a branch point of view and from a bank point of view, solely it is standalone. It will be RBI. So RBI has for your advances, there is IRAC norms that needs to be complied with. IRAC norms stand for what? Income recognition asset classification. So basically, when your advance is to be treated as standard, when does it become an NPA is governed by your NPA norms. Apart from that, there is a requirement of capital adequacy. Are you aware about what capital adequacy is? So for banks to function long term with a going concern concept in mind, it needs to have adequate capital. If the borrowers or if the depositors come and withdraw entire amount, in that case, bank could go bust. So thus it needs to maintain a balance of how much capital they are maintaining with with the bank, and for that there are norms which are prescribed by RBI, which are capital adequacy norms. Apart from that, we have FEMA, which is applicable in case of foreign exchange transactions. Then she's also covered is for fraud detection. There is a separate fraud detection circular. In the slides will be shared with you. So in slides she's also mentioned that when you go on the RBI site, how do you exactly search a respective circular. So if you want to search a circular for IRAC norms, how do you go, and what all, where is the notification tab where you need to enter the name of the circular, what area you're looking out for. So this is something, before going to your branches, try and take a track of all the applicable relevant circulars, especially the circulars which have been released during the year. So those are some things which you need to focus primarily. Then she's also covered here is yeah, so now she'll be taking us through very key terminologies. So basic bank branch audit, what are the basic terms that you need to be aware of? Go ahead, sir.
So, moving to the next slide. Key terminologies. Let's consider a simple scenario. Suppose you have taken loan from a bank to buy your dream car. You're excited about your new vehicle, but due to some unforeseen circumstances, you miss your monthly EMI payment. Now, what happens next? Does the bank immediately classify you as a defaulter? No, but it starts monitoring your repayment status using specific classifications and regulations. Today, we will break down some key banking terminologies, not just their definitions, but how they work in real life. Let's start with the first and most basic one. The first key terminology is overdue. So a loan is considered overdue when a borrower fails to make the payment by the specified due date. The moment the due date passes without payment, the loan falls into the overdue category. For example, your EMI was due on March 31st, but you failed to make the payment. Your loan account becomes overdue starting from April 1st. The next is NPA, non-performing asset. A loan account becomes a NPA if overdue amount remains unpaid for more than 90 days. For instance, your EMI due on March 31st is still unpaid on June 30th, it will be categorized as an NPA. Once classified as NPA, the bank needs to make provisions for potential losses. So for different types of loan, we need to follow different NPA classification norms, which Atharva will cover in the upcoming slides. The next is special mention accounts, SMA. So before a loan turns into an NPA, banks closely monitor overdue accounts through the special mention account classification. This system helps banks identify and manage risks before they escalate. Suppose your EMI due on March 31st remains unpaid for 0 to 30 days, your account falls under SMA 0 category. This stage serves as an early warning signal for your potential stress in the account. If the overdue period extends between 31 days to 60 days, the account is categorized as SMA1, and if the non-payment continues for 61 to 90 days, the account moves to the SMA2, signaling high risk. The next is days past due, that is DPD. The DPD refers to the number of days a loan payment remains unpaid beyond the due date. For instance, if your EMI was due on March 31st and you still have not paid it by April 15th, the DPD count will be 15th days past due. That is DPD 15.
So if supposingly now you have taken a loan, and for that loan your EMI is due on say 5th of March, and you somehow forget and you don't pay your EMI. So on 6th of March that account will become overdue. It won't become a NPA. It would become an overdue. Now, when it becomes an overdue, if it stays overdue for 90 days period, is it 90 days or is it 3 months? 90 days. So strictly as per RBI regulation, it has to be day wise calculation. So you have to calculate 90 days. If it remains overdue for 90 days, then immediately it will become an NPA. Now, what are the criteria for a loan to become an NPA? It depends on what kind of loan is it. Whether is it a CC, whether is it an OD, whether is it a term loan, a personal loan, or whether is it a bill discounted. So that all those norms are depend. I mean, she'll be covering the types of advances also, and what are the criteria for them to turn NPA. Those also will be covered. Now, what is an SMA account? Are you all aware about SMA? The concept of SMA? So basically, what is an SMA zero account? Correct. So if there is a if there are overdues from 1 to 30 days, ideally, then it becomes a SMA zero account. If it is overdue for 31 to 60 days, it becomes SMA one, and if it becomes 61 to 90 days, it becomes SMA two. Now, what is the significance of SMA accounts? Like, why are they important? Correct. So they are like potential NPAs. So if there is an SME2 account, it remains an SME2 account. Those should be your focus areas in the branch. You should immediately ask them that show us some SME2 account. Why is it remaining SME2? Is there some kind of window dressing or is there some kind of adjustment that is happening in that particular account? So which is why you need to know, is everybody a second year article here, or we have a mix of first and second and third year? It's a mix, right? Okay. So this level, I mean, we are okay with this, right? If you're going as basic as this, all right, fabulous. TK. And what is DPD is basically the number of days your account is overdue. So if the account was the EMI was due on 5th of March, you haven't paid it till 20th, then it is a 15 days. There's a 15 days DPD. Okay, so that you need to know. So basically, 30 days DPD, it'll be SMA one SMA zero account. 31 days, it'll be an SMA two. That's how you need to know the terminologies. Next terms.
Let's move to the next key terminologies. The next one is drawing power. Drawing power is the maximum amount that a borrower can withdraw from a cash credit or overdraft facility based on the value of available security. For example, if a business pledges inventory worth rupees 50 lakh and the bank applies a margin of 20%, the drawing power would be 40 lakh. This ensures that borrower cannot exceed the eligible limit. The next key terminology is out of order. A cash credit or overdraft account is classified as out of order if any of the following conditions persist for 90 days or more. The first condition is the outstanding balance exceeds the sanctioned limit or drawing power, whichever is lower, or the credits in the account are insufficient to cover the interest due, or the account shows irregular transactions with no significant credit inflow. Since these are independent conditions, meeting any one of them is enough to classify the account as out of order. Our next key terminology is security. You all know that security refers to an asset that a borrower provides to the lender as a guarantee for a loan. It helps the lender recover the dues in case of default, and it includes mortgage, hypothecation, and pledge. Let's look at the first mortgage. When a borrower takes a loan by providing immovable property like land, house, or building as a security, it is called a mortgage. The borrower retains the ownership, but the bank holds the original property documents until the loan is fully repaid. For example, if a person takes home loan and the bank mortgages the house, keeping the property documents as a security. Next is hypothecation. When a borrower offers movable assets like vehicles, stocks, or machinery as security for a loan, but retains both ownership and possession, it is called hypothecation. The bank does not hold the original documents but has a legal right over the asset. For example, a business takes a car loan and the vehicle remains in the borrower's possession, but it is hypothecated to the bank. Next is pledge. When a borrower physically hands over the movable assets like gold, shares, or goods to the lender as security, it is called a pledge. A bank holds the asset and its documents until the borrower repays a loan. For instance, a person takes a gold loan and pledges gold jewelry to the bank, which keeps the gold until the loan is cleared. So, our next key terminology is moratorium. Basically, moratorium is what? It is a suspension of loan repayment obligation typically granted during financial distress. For example, a student takes an education loan with a 1 year moratorium after course completion, meaning they don't have to pay EMIs during this period. Once the moratorium ends, they start repaying the loan with the interest.
Right. So, what is the drawing power? You're aware of it, right? And how is drawing power computed?
Based on the successes and LTV.
Based on
The power, I mean, assets and the security.
security that has been right. So I typically it is applicable in case of CCs and ODs. What is a CC, what is OD, she'll be covering. So drawing power is the amount that you can withdraw. So there is a sanction limit which you are giving by which you are given by the bank, and within that limit, then based on your drawing power, you can withdraw the amounts, which is not always standard. So for example, at the beginning of the year, your sanction limit is say 1 crore, but throughout the year you may not have that much of drawing power depending upon what is the stock that is available with you, what are the debtors that are available with you, what are your payables, creditors, depending upon that your drawing power keeps on changing. So drawing power is something which you need to know how to calculate and how to check. Then, when does an account become out of order? There are three conditions that she has explained. What are that? When does an account become out of order? Again, which is applicable in case of CCs and ODs. Securities. There are three kinds of securities: mortgage, hypothecation, and pledge. In case of mortgage, the asset remains with the borrower, but the original titles are to be submitted to the bank. So, like if we go for a housing loan, we have to submit our original documents to the bank, but house we'll retain with us until we repay the entire amount. In case of hypothecation, our stocks. So, in case if you've seen in behind some of the buses, also they've mentioned hypothecated to so and so bank. So basically, until and unless that particular dealer or that particular manufacturer doesn't repay the entire amount, the charge on that particular bus will remain with the bank. Although the that particular stock or that particular bus will be utilized by the manufacturer itself. And last is your pledge. Pledge is where typically you are depositing your actual asset with the bank, like gold loan. So you go, you place your gold jewelry. They will assay it. Assay it means they will look at the purity. They will look at the its assessable value, its saleable value. They will assess all of that, and based on that, they will sanction you a particular loan. So that is pledge. And then moratorium period is a period for which you don't have to repay your loan. It could be entire EMI could not be repayable, or sometimes what the bank says is that no, only interest amount you'll have to pay, but principal you can start repaying later. So typically after your education, like if you go for higher education, say I am an IITs, if you go over there, bank will say that no, for 2 years we'll give you a loan, your education loan. You can start repaying only once you get your job after 3 years. So that those 2 years where you are enjoying the facility with the bank without really paying anything in return is your moratorium period. ठीक है?
Let's proceed with the next terminology, which is MOC, Memorandum of Changes. MOC refers to the adjustments suggested by us auditors in the financial statements. These changes are recorded when discrepancies or errors are identified during an audit. For example, if an auditor finds that an interest income is overstated, an MOC will be issued to correct the amount in the bank's books. So, based on the terminologies I have explained, let's move to some case studies.
You're aware of MOCs, right? The concept of MOCs is clear, right? Whenever there are any kind of changes that you need to incorporate in your financial statements, it is always done through MOCs. So your partners or your managers, they will always ask you, MOC pass kara hai kya, kitne ka pass kiya? So that is where you need to know. It is basically what are the queries that you have raised to the bank where they have gone wrong with their calculations, where they should have marked an account as an NPA, but they have not done that for whatever reason. So those kind of changes are to be, those kind of rectifications are done through MOCs, right? So MOC, you should always check MOCs. Ask them for last time ka MOC kaisa.
Let's move to the case studies. The first case study is in the case of a cash credit facility, if the account remains continuously overdrawn beyond the sanctioned limit but does not exceed the drawing power for a period of 91 days, would it be classified as an NPA? Yes. The answer is a cash credit account is classified as NPA if it is deemed out of order. This occurs when any of the following conditions are met. The first condition is the account remains continuously overdrawn for more than 90 days beyond the sanction limit or the drawing power, whichever is lower. And the second condition is even if the account has sufficient drawing power, but it will still be classified as NPA if the outstanding exceeds the sanction limit for more than 90 days.
So to take this ahead, for example, now if your sanction limit is say 1 crore and your drawing power is say 80 lakhs, the amount that you have withdrawn and the amount outstanding is say 90 lakhs, and this remains like this for 90 days. Will the account be an NPA? The sanction limit is 1 crore, but the drawing power was 80 lakhs. So how will you assess this? Whether is it an NPA or not?
Second condition will apply. Sufficient drawing power, it will be classified as NPA if the outstanding exceeds the sanction.
Correct. So sanction limit or drawing power, whichever is lower. So that you'll have to assess. So it could also happen that the sanction limit was 1 crore, but the drawing power is 1.2 crores. In that case, you'll have to see. You'll have to keep the sanction limit only as your base. And if the outstanding is 1.1 crore and that remains like it does, the condition continues for 3 months, again it will be marked as NPA, right? Then apart from that, that's the condition that she's also mentioned in the example. The second one.
Second case study is in case of a cash credit or overdraft facility, if an account remains with the sanction limit within the sanction limit, but the total credits in the account during the quarter Jan to March 2025 are less than the interest debited during the same period, would the account be classified as NPA as per the regulatory guidelines?
Yes. So ideally, what so ideally what you need to do is that so ideally what you can do is whenever you go to bank, you ask them, your branch people, that you give me a report where there is total interest debit and total credit summation summary. So there, that itself will give you a base. If you have a total of interest that has been debited and the total of the amount that has been credited during say last 6 months or last 3 months, automatically you will be able to assess such cases. So instead of looking at individual cases, you ask them this report that advance wise I want total interest debited and total credit summation.
The answer for the case study is the account would be classified as NPA as it is considered out of order, and the account is deemed out of order if the total credits during the quarter are insufficient to cover the interest debited during the same period, and in this case the credits in the account are less than the interest debited, it meets the criteria for NPA classification. Moving towards the next slide. It is an essential part of a bank's financial statements advances. For your reference, Here is the format of Schedule 9 advances, which represents the total amount of loans and advances given by the bank to the customers. For a deeper understanding, let's take a look at their classification based on the different parameters. First classification is classification based on the sector. It includes two parts, priority sector and non-priority sector. So priority sector advances are the loans given to specific sectors such as agriculture, MSMEs, education, and housing for weaker sections. For example, a farmer availing of an agriculture loan to buy fertilizers. And non-priority sector advances include loans given for purposes that do not fall under the priority lending, such as corporate loans, personal loans, luxury home loans. Can anyone guess why banks are required to give a certain percentage of loan to the priority sectors?
You're aware that there is a priority sector. So what is the regulatory requirement around it?
So that the bank don't only give the loans to the corporates and gain the interest. It is means the for the income generation so that the means low income group people also can generate the wealth and
Okay. Is there any regulatory requirement though, or is it the intent?
private sector lending is a circular.
Right. So what does the circular say? I mean, so there is a separate circular dated. There is a separate circular dated, I think September, for July 2000, 2016. So that circular is there, where basically RBI requires that certain amount of your loan portfolio should be given to priority sector, and if you fail to do achieve that amount, then in that case you'll have to invest in some particular bonds. That amount of money you'll have to invest in your bonds. So either you give your available funds to priority sector loans, and if you're not fulfilling, then you'll have to submit in that particular bonds, NABARD, which is mentioned in the circular. So which is why it is important. So we as auditors, we need to identify and we need to ensure that if they are claiming an account to be belonging to a particular priority sector, whether the requirements of those circulars are being complied or not, whether is it really a priority sector what they are claiming. So this is something as branch auditors you need to be very careful of. So this is classification based on sector. Next classification.
Next classification is classification based on security. It includes secured advances and unsecured advances. Secured advances are loans or advances granted by banks that are backed by security, such as property, fixed assets, stocks, or other guarantees. The security serves as protection for the lender, reducing the risk of default. For example, a housing loan where the property itself acts as a security. And unsecured loans are the loans that are not backed by any security or asset. Since there is no security involved, lenders rely on the borrower's creditworthiness, income, and repayment capacity. For example, student loans granted based on the borrower's creditworthiness and academic background. Let's see the classification based on the fund utilization.
So what is the difference if it is a secured or an unsecured account? What difference is it going to make on the branch risk weight? Correct. And any other difference? Provisioning. Correct. So provisioning norms also, if it is secured, then secured portion have a smaller amount of provision that you need to make. So which is why every time you get, if the branch claims that this is the portfolio of our secured borrowers, you please ask them, you please show us what are the securities. You just ensure that the charge has been created or not. Because in one of the branches that we were auditing, we did come across a case where the charge was created on by two different entities, or maybe or the charge that was created was not authentic. So in that case, we had to simply declare that as completely unsecured, and we one of the auditors even issued it to the RBI as a fraud account.
You verified that the charge is unauthentic.
So, Sarsai, there is a Sarsai portal where you can go and you can see what exactly is the what are the asset that has been charged and to whom it has been charged. That can be verified. For home loans, correct. So that was a case of home loan where which was verified. So similarly, there are ways in case of loans which are more than 5 crores, their stock audit needs to be compulsorily carried out. So there you obtain latest stock audit report, you look at their sanction and what is the frequency with which they are required to conduct, and whether that stock audit report is there in place or not. So such things as auditors you'll have to be mindful of when it comes to classification based on secured unsecured. Next.
Let's look at the next classification, which is fund-wise, and it includes fund-based advances and non-fund-based advances. Let's first look at the fund-based advances. It further includes cash credit, overdraft, and term loans. So the fund-based advances involve direct disbursement of money to the borrower's account. And for cash credit, it is a short-term facility given to businesses to meet working capital needs. It allows businesses to withdraw funds up to a sanctioned limit, even if they don't have enough balance in their account. An overdraft is a facility that allows individuals or businesses to withdraw more money than they have in their account up to a predefined limit. It is typically offered against the fixed deposits, salary account, and other financial credentials. Now, both definition look similar, but there are two main differences between cash credit and overdraft, which are in case of CC, it is specifically for businesses to meet the working capital needs, but the overdraft is for both individuals and businesses to manage the short-term liquidity. And in case of CC, it is secured against stock, receivables, and business assets. While on the other hand, overdraft can be secured against FD, property, or it can be unsecured too. And a term loan is a loan provided for fixed period, usually for purchasing assets, business expansion, or large capital expenditures. And its repayment is done in EMIs over a predefined tenure. Next, moving on, non-fund based advances. It includes bank guarantee and letter of credit. Let's understand it with an example. If a Chinese company wants to buy machinery from an Indian company, but the Indian company fears non-payment. Now, to assure the payment, the Chinese company asks its bank in China to issue a document in favor of the Indian company. This document is sent to the Indian company's bank, guaranteeing the payment, but only if shipment conditions are met. Now, the Indian company ships the machinery and submits the documents like invoices, bill of lading to its bank, which verifies and forwards them to the buyer's bank. Once confirmed, the Chinese company's bank releases the payment, ensuring a secure transaction. This document is called a letter of credit. Now, continuing with the same scenario, now to assure the Indian company, Chinese company asks its bank to issue a document guaranteeing the payment only if the Chinese company fails to fulfill its obligation. This document is sent by Indian company's bank as a payment guarantee. If the Chinese company does not pay as agreed, the Indian company can claim amount from the bank. Now, this document is called the bank guarantee. And the main differences between LC and BG are, in case of letter of credit, bank pays first. The bank guarantees payment to the seller after verifying documents like invoice and bill of lading. And in case of BG, bank pays only if the buyer defaults. Next, let's look at the classification based on prudential norms. Standard asset and NPA, non-performing asset. Standard assets are the loans where payments are made on time, and non-performing assets is if a loan remains unpaid for more than 90 days, it is classified as an NPA. As I told, Atharva will be explaining different types of loans, different types of classifications, and NPA classification for the different types of loans. In summary, banks classify advances based on sector, security, fund utilization, and prudential norms. Now that we have covered the basics of bank branch audits, including planning, advances, key terminologies, and regulatory framework, I would like to invite Atharva to take us through the next topics. Over to you, Atharva.
Thank you, Sanskruti. Hi, everyone. I am Atharva. So, friends, till now we have discussed regarding planning of an audit, the different terminologies. After that, we have covered many areas. So now we shall be focusing how the audit is to be actually performed when you actually visit a branch. So we shall now focus more on our core audit areas, that is regarding advances, IRAC, NPA, deposit, GLPL items. So starting with the advances, as we all know that lending constitutes a major source of activity for every bank. Schedule 9 of Form A, which consists of advances. Generally, it is the largest item on the asset side of bank. Now, it also considered as a major source of revenue for the bank. Checking of advances is not only important from the point of view of asset side, but it is also essential as we sign various returns and certificates which are on the basis of advances. Audit of advances is one of the most important areas to be covered by statutory branch auditors in bank branch audit. As a statutory branch auditor, we should be known to various financial areas such as procedures, processes, credit approvals, CBS system, prevailing internal controls which concern advances. So let us now move towards the audit approach and audit procedure while we perform audit of advances. So as we already have mentioned, our audit requirement for advances in initial requirement list, which Sanskruti has already covered in above slides, we shall now begin with the audit of advances. So after obtaining a list of advances, the auditor should verify its completeness by comparing the amount appearing in the advances dump with the amount shown in the balance sheet, that is GL. In carrying out audit procedures for advances, the auditor should examine all large advances, while other advances, which are small in nature, shall be examined on a sample basis. What constitutes a large advances needs to be determined in the context of volume of the branch with it deals and the materiality level which the auditor of the branch assess. Now let us begin with uh, the overall advances and the few following things which we as an article and the auditor we should keep in our mind so that we can plan a comprehensive coverage of overall advances. So starting with, we should obtain a list of top or large exposure accounts. We should also obtain a list of SMA accounts, as Sanskriti has already helped us to know how important SMA listing is. So after that, we should obtain a list of all the restructured accounts during the audit period. We should also ask the client for quick mortality cases. Now, quick mortality cases, we know that where advance becomes NPA within 12 months from the date of its sanction. We should obtain a list of quick mortality cases. Again, we should obtain a list of all the accounts which are upgraded and degraded during the period. Next, uh, after obtaining the list of advances and verifying their completeness, the auditor should now start sample selection for checking his advances. The auditor should ensure that the sample is representative of overall portfolio of the branch advances, and also he should focus on higher material risk areas. So sample selections can be done in two ways. First, advances which are sanctioned during the year, that is new advances. Secondly, advances that are sanctioned prior to the current year, that is existing advances. So the method for checking both new and existing advances may differ, but common comprehensive audit process which we can follow is what we can see on the screen. So in case of new advances, we can obtain the details of relevant KYC details of the borrower, whether they are properly documented by the branch management. Secondly, we can see whether the disbursement of the loan is as per the terms which are sanctioned, and it should be signed by both the parties. Thirdly, we should see the type of facility availed by the borrower, whether it is a cash credit or a overdraft or a term loan. So after that, we should see what securities are being given by the borrower to us, whether it is a collateral, it is a primary, or it is hypothecation of some movable items or mortgage of immovable property. We should also check for the interest rate which are given in the sanction letter. These should be properly fed in the CBS system of the branch. We should also check whether the sanction letter is valid for throughout the loan period, or whether it is valid for a period of 6 months or 12 months. Moving towards checking of existing advances. Now, these existing advances are the advances accounts open with the branch from a longer period of time. They might have new facilities sanctioned during the period, but the loans are being carried out from a previous period. So we should be checking the operations in the accounts, all the debits and credits in the accounts. We should also check for asset classification. If it is a stressed asset, that is a special mention account. So as per SMA 0, SMA 1, SMA 2, we shall check the asset classification. We shall also check whether there is change in interest rate, whether there is change in MCLR. We should also check for the IRAC provisions. So now let us move towards how overall we can conduct audit of advances. So let me just
So once you visit the branches, now you obtain the list of all the returns. The returns includes your balance sheet. In balance sheet, there must be a figure of Schedule 9 advances. Total amount is so and so. So once you obtain the list of advances, the detailed dump or the loan balancing file as they call it, first you have to ensure the completeness. You have to tally ki jo total that they are mentioning in your loan balancing file, whether is it matching with your Schedule 9. So that you're securing yourself that you've obtained the entire information, the entire population. And then based on that, you have to start your examination of individual areas. You should start giving out your samples. So for samples, again, what he's asked is, you ask them what are your top five. You sort your loan balancing file based on the sanction limit or based on the outstanding, which is the top five borrowers or top 10 borrowers, depending upon what is the comfort that you're getting, how much is the area, how much is the percentage of population that you're able to cover. Then other ways could be your NPAs. If you obtain the list of NPAs, and if you can see that there are some quick mortality cases. Quick mortality cases means the account turned NPA within 1 year of being sanctioned. So such then is there any particular kind of trend that the branch has, or is there any kind of weakness in their internal controls? Immediately these are your indicators towards a weaker this thing system in the branches. Then what you can also do is you can divide your samples into new advances and existing advances. For new advances, you ask them for a basic, all the basic documents, right from your sanction, your KYCs, your disbursement details, when and how was it disbursed. All those documents you can ask. In case of existing, you may assume that your previous auditor must have checked it, but for your comfort, you can again ask for these documents. But in case of existing, what you can focus more on is the operations in the accounts. So for all the accounts, you open their statement of accounts, you download their statement of accounts, see what is the trend, how frequently is the account going into SMA, how frequently is the account, how prompt is the borrower in terms of repayment. So this is your basic things that you will be checking. You divide your sample based on all these criteria. So now Athara will also show you that when you have obtained your listing, what are the individual items that you need to check in your advances checking. So
so
now,
now as we have taken samples from our new advances and existing advances, let me just share my screen to go. Yes, so as you can see on your screen, the Excel, which consists of serial number, PAN or customer ID, account number, account name, account opening date, date of sanction in the account, what is the scheme of the loan, under like what kind of loan it is basically, what is the class of loan, basically it is a standard loan, substandard, doubtful, or a loss asset, whether it is a technically write off account, whether any fraud has been committed till the date in that account. So all the uh, all the fields which you see highlighted on your screen right now are the basic dumps which your client gives you, that is your branch provides you with. And this contains a listing of all the advances. Ideally, the total of these advances, which is fund-based plus non-fund-based, should match, and there should be a completeness as regard to the amount appearing in your balance sheet. So now what shall we be auditing in advances? So as you can see on the right side, the green portion, which I have highlighted right now. So this is the part of the auditor checking which we should be doing, we should be performing in the branch. So firstly, we should be looking after the facility, which facility is taken by the borrower. It should be mentioned in the sanction letter. What is the amount of loan borrowing which is outstanding as on the audit period. Nextly, we shall checking the sanction limits. What limits are there in the file, sanction file basically? What has been entered into the system? Is there any kind of difference in any of the borrower? We should ask the management if there is any deviation and take down their remarks. Next, we can see whether the charges are properly recovered. Now, every sanction document contains different types of charges like processing charge, inspection charge, documentation charge, whether the same has been calculated properly and has been recorded properly by the bank in his system. Now we shall compare the interest rates which are appearing in the sanctioned terms. We should check it with what has been entered into the system, whether there is any deviation. And if there is a deviation, we shall again take a remark from our branch management. We shall be checking the repayment schedule. Basically, whenever a loan is been sanctioned, a term loan is sanctioned, a repayment schedule is already given by the bank. Whether the repayment schedule is properly entered into the system. Next, in case of security, what are the security details? In case of credit rating, there can be external credit rating, and even every bank has its internal credit rating parameters. Both the credit ratings are entered into the CBS software. So
So So essentially, when you are so mute. So essentially, when you are reviewing your advances, what are the documents that you are reviewing is what is there in your file and what is there in your system. So please understand, people who are sanctioning a particular limit are different, and people who are actually entering it and monitoring it in the system are different. And that is what we are as auditors are checking, that what has been sanctioned is actually been disbursed or has been actually been entered in the system also. So देखने में it sounds very simple कि limit तो same ही होगा as per sanction ही होगा, but the reason why it needs to be seen is because sometimes there are different authorities who can who are allowed to give a loan up to a particular limit. So some could be done by the managing committee which resides at their head office, but the account is being monitored through branch. So therefore, you always obtain your sanction letter and verify these basic things. Similarly, charges. Now, if a borrower is required to pay a particular charge, if the bank is not recovering those charges, it's a revenue leakage for them. So you as auditors, you can always look and you can highlight it to them that you've not charged processing charges, or you've not charged documentation charges. So please recover these charges from your borrowers. Then apart from that, your interest rates, interest rates again forms a part of your sanction letter. That also needs to be entered in the system, because based on that, interest is going to be charged. Based on that, your provisioning norms and all are going to get affected. So all these details you have to verify with your hard documents, which the branch will provide to you.
So moving towards the next core areas of audit is IRAC norms. So basically, IRAC norms have been divided into two parts, that is income recognition and asset classification. So let us begin with the first, that is income recognition. So as we all are aware that in case of income recognition, we do perform for two kinds of assets, that is standard assets that are performing and the non-performing assets. So in case of standard assets, we recognize the revenue on the basis of recovery. We regularly accrue the interest in the customer account, that is borrower account. But whereas the case is different in case of a non-performing asset. In case of a non-performing asset, whenever the account turns NPA, so at that time, the bank branch should reverse the accrued interest in the borrower account. Similarly, after the date it has been classified as non-performing asset, branch should not charge the borrower with any kind of charges like stamp duty, processing charge, or documentation charge, inspection charge, and similar. So moving towards the second part, which is asset classification. Now, as Sanskruti has already covered in the earlier part regarding asset classification as per the IRAC norms, that is the concept of out of order and all, we shall now have an idea regarding what asset classification is about. But we shall go in more details right now. So, starting with the first is security value erosions. So, accounts where there is a erosion in the value of security or frauds have been committed by the borrowers. In respect of those accounts, it is not prudent that such account should go through various stages of asset classification from substandard to DB1, DB2, and then classify as loss. In case of serious impairment, credit impairments, the asset should be straight away classified as either doubtful or either as a loss. So, in case where the where there is a erosion in the value of the security, which is recognized significant by the branch, and when the realizable value of the security is less than 50% of the outstanding balance of the borrower, such an NP account should be straight away classified into doubtful category. And as per the provisions of NPA, certain provisions would be made on that doubtful category. But if the realizable value of the security, as assessed by the bank or by the auditors of the bank, is less than 10% of the outstanding balance of the borrower account, the existence of such security should be completely ignored and the asset should be straight away classified as loss asset. 100% provision would be made on loss assets. There can be cases where there is uh, temporary deficiencies in borrower account, like in case of a term loan, whenever the borrower does not pays his installment for a continuous period of 90 days or the account remained overdue. But uh, apart from that definition, but whenever the valuation report which has been submitted in case of a term loan by the borrower, we as an article should also be aware and we should be checking that if the valuation report is older than a period of 3 years and the significant amount of uh, advance is outstanding in the borrower account, we should be classifying the account as NPA. Secondly, in case of a cash credit and overdraft accounts where the interest is overdue or the interest is being credited but it is not enough to cover the interest which is charged in borrower account. But the bank should ensure that the drawings in the working capital accounts are covered by adequate current assets. Basically, drawing power is required to be arrived at the on the basis of latest stock shipments. However, if the stock shipments are older than a period of 3 months, then the drawing power is calculated on the basis of expired stock shipments. Basically, this is deemed to be a irregular limit. So, a working capital account which will be classified as NPA if such irregular limit for drawing power is been permitted continuously for a period of more than 90 days. There can be third case where loans are given with a moratorium for payment of interest. As Sanskriti has already covered what is moratorium, let me summarize it. Whenever in case of a agricultural loan or an industrial project or in case of educational loan and so on, where the bank has given a moratorium facility, that is the interest shall be paid after a few years. So the account shall not be instantly recognized as a non-performing asset just because it has not been charged with interest for continuously of more than 90 days. We shall now move towards the fourth category, that is agricultural advances. Now, in case of agricultural advances, we need to check that whether the loan given is a short duration crop loan or it is a long duration crop loan. In case of a short duration crop loan, generally we should not consider it as NPA if the interest portion or the principal portion is overdue for a period of up to 2 short crop seasons. In case of a long duration crop, the account will be treated as NPA only and only if the installment of principal or either the interest is overdue for a period of 1 crop season. Now let us move towards a case study. So the question is, if a borrower has multiple facilities outstanding, including cash credit, housing loan, personal loan, and there are 4 overdue EMIs in the personal loan account, should the cash credit and housing loan account also be classified as NPA? Please comment down your answers in the chat box. As per the regulatory guidelines on NPA classification, if a borrower has multiple credit facility and if any one of the facilities become non-performing asset, all other facilities of the borrower with the same lender would be classified as non-performing asset. This is known as borrower-wise asset classification, that is NPA classification. And in the given case, since 4 EMIs are overdue in personal loan, it is classified as NPA. Now let us move towards the other core areas of audit, that is non-performing assets. So as we can see on the screen that the period for non-performing asset in case of a standard account is 0 days. Like as such, there is no period for standard assets to be considered as NPA. But Reserve Bank of India requires certain percentage to be provided on standard assets, which are as on the screens. Further, prudential norm classifies non-performing assets into three major categories, namely substandard category, doubtful category, and loss category. But one important point to remember here is that while we calculate the amount of provision in case of advances, we are required to bifurcate the borrower between the amount outstanding, which is secured by primary or collateral security, and the amount of outstanding loan, which is unsecured. So let us move towards the first classification, that is substandard asset. A substandard asset would be one which has remained in NPA category for a period of less than 12 months or equal to 12 months. In such a case, we shall provide 15% of provision on secured portion of the loan, whereas unsecured portion of the loan would be provided for 25%. Now moving towards the second class, that is doubtful asset. An asset would be classified as doubtful if it has remained in substandard category for a period of 12 months. Now, in case if the asset is classified as doubtful for a period of up to 1 year, the secured portion of the asset should be provided with 25%, whereas 100% provision will be made on unsecured portion of the loan. In case the asset is doubtful for more than 1 year up to 3 years, 40% of the provision would be made on the secured portion, whereas unsecured portion would be 100% provided for. In case asset is doubtful for a period of more than 3 years, 100% provision is to be recognized on both secured portion and unsecured portion. And lastly, talking about the third class of asset, that is loss assets. A loss asset is one where loss has been identified by the bank or either internal or external auditors of the bank or through RBI inspections, but the amount has not been yet written off from the balance sheet of the bank. So in this case, 100% provision should be made on the loss category and the asset should be written off from the balance sheet. Now, please note that the asset classification here as per NPA norms is borrower wise and not facility wise. Also, please take a note that these are the minimum percentages prescribed by Reserve Bank of India. So in case a bank is providing more percentage than what has been prescribed, it is always free to do so, but it should do with consistency. However, it should not make provision which is less than what has been prescribed by Reserve Bank of India. So I have a question for you guys. What should the bank do when an account turns NPA? Yes. So in case an account turns NPA, the bank should firstly reverse the income if any advance, including bills purchased and discounted, becomes non-performing asset. The entire interest accrued and credited in the unmuted. The entire interest accrued and credited to the income account in the past period should be reversed and if the same is not realized. Secondly, in respect of NPA classified accounts, bank should not charge further fees, commissions, and similar income that has accrued in the case. It would cease to accrue, and in case if it has been accrued in the past period, it should be reversed by the bank. Now, talking about the interest application portion. So, when an account turns NPA, bank should reverse the interest which is already charged in the account by not by debiting the P&L account, and the bank should stop further application of interest in the borrower account. But however, the bank may continue to charge the interest in memorandum books of the bank on the back end. And also we should take a note that while we calculate the amount of gross advances, we should not take into consideration the interest which is accrued in memorandum books of account.
एक सेकंड म्यूट कर. So here, I just want to add one thing. Now, what you can do is when you go to your branches, when you obtain a list of NPAs, you also ask them that give us the list of NPAs as on 31st March of the current year and 31st March of the previous year. So you compare this NPA listing. You conduct various VLOOKUPs between date on which NPA was declared, the date on the amount outstanding also. So what kind of things it will indicate? Firstly, date of NPA should not be changed. Ideally, if an account has become substandard last year, it should have become a DB1 right now. But since they've changed the date, it is still shown as substandard only, and it's not changed its categorization to DB1. So such cases you have to be very mindful of. Similarly, there would be a change if there is a change in outstanding amounts. Ideally, they cannot charge anymore, as he's mentioned, any kind of fees or commission or any kind of expenses to that particular account. So those, if the outstanding balance has increased, that also will become your indicator. You have to ask them what are the charges that have been charged. If they are wrongly being charged, they have to be reversed. Yeah.
So let us now have some illustrations at a glance. So the first case is regarding out of order. A business owner, Mr. Raj, has an overdraft facility of 10 lakh rupees with XYZ Bank. He frequently withdraws money for working capital and repays as per his cash flow. Due to financial difficulties, Mr. Raj stops depositing enough fund to cover the interest payment or reduce the balance which is outstanding. Now, can you please tell what are the NPA provisions in this case? Please comment down your answers in the chat box. So the answer is that since Mr. Raj is depositing funds, but those funds are not enough to cover the interest which is charged in Raj account, bank will classify Raj account as non-performing asset. So let us now see second case. Rahul buys a house on loan and loses his job and stops the payment of EMI. Now, what should the bank do? So, if the EMIs are overdue for a period of more than 90 days, Rahul's account will be marked as NPA and the bank may seize the possession of his house if it is given as a security. Now, in third case is regarding bills of exchange. On 25th September, Mohan discounts a bill drawn by him on Krish through a nationalized bank. On date of maturity, the bill gets dishonored. Now, who shall the bank declare as non-performing asset? B. Mohan or B. Krish? Exactly. So bank, when the bill is not honored on its maturity, bank will treat the bill as non-performing asset, and bank will hold Mohan liable for non-payment, and bank will mark all accounts of Mohan as non-performing asset. So let us now see some other core areas of audits. Like other core areas includes the items of balance sheet and profit and loss account. Like as we can see on the screen, there are deposits, provisions, which are a part of liability side of the balance sheet, basically. Then cash and bank balance, fixed assets, current assets. These are a part of asset side of the balance sheet. And lastly, contingent liability, which is off balance sheet items. So these are the other areas which we shall have a look over. But as the motive of today's session is more to focus more on advances portion, so we shall be covering more about advances.
Correct. So you will typically, when you go for your branch audits, you will be asked to take a tally of, to verify the cash balances, the ATM balances. Those checking you will be doing. Then deposits, you'll avail a list of deposits. You will verify some samples, whether the interest that has to be charged to those deposits, if there are any kind of premature deposits, whether interest has been correctly uh, booked or not. If they are premature, then in that case, whether the bank has charged penal interest or not. So all these things you will be typically looking at. Even fixed assets, whichever are there at your branch, you will calculate and you'll recalculate and see the depreciation amounts. So all these checkings you will have to do. But right now, as he's mentioned, we are focusing mainly on advances.
Moving towards the next portion of our presentation is long form audit report. So long RBI has issued a circular applicable for long form audit report dated September 5, 2020, which all the auditors, be it a statutory central auditor or a statutory branch auditor, are compulsory required to follow. This circular covers the areas into two formats, basically Annexure 1 and Annexure 2. in which Annexure 1 is to be complied by the statutory central auditor of the bank, whereas as a statutory branch auditor, we are required to focus on Annexure number 2. Now, LFAR, that is long form audit report, refers to a detailed audit report prepared by statutory auditors of the bank and branch. The overall objective of long form audit report is to provide observations that identify and assess gaps and vulnerable areas and provide an independent opinion on the same to the board of the bank. It has it is also involving comments on various risks to which the banks are exposed. Now, long form audit report is considered at the planning stage. It serves as a vital tool and a checkpoint for auditors and their team members to conduct the audit. When performing annual audit of a bank branch, the auditor is required to submit long form audit report along with the bank's financial statements for the financial year end. The matter to be dealt in by the auditors in long form audit report has been specified by Reserve Bank of India. One of such areas is to comment on all large advances. Now, what are large advances? So, as per the revised guidelines on LFAR, large advances are those in respect of which the amount outstanding is in excess of 10% of either of both fund-based plus non-fund-based facilities, or 10 crore, whichever is less. The branch auditors are expected to submit the LFAR in a format prescribed to the branch by the Reserve Bank of India. In whole, the exercise of long form audit report audit documentation plays a very vital role, and the branch auditor should collect all relevant and important documents such as his work papers so that he can support his views and opinions which he has expressed in the report. Now we shall move towards the next slide. The next slide. So as we are concerned about the bank branch audit, our focus would be more on Annexure 2, that is the coverage in long form audit report by statutory branch auditors. Basically, Annexure 2 is divided into 4 parts, namely assets, liabilities, profit and loss accounts, and general items. We shall discuss each one of them. So starting with Annexure 2, the first is asset. So in asset, we generally have a questionnaire with regard to cash, cash with RBI, cash with other balances. We have a complete detailed questionnaire with respect to investments, with respect to the fixed assets, whether they are properly maintained by fixed asset register are properly maintained by the bank. Next is our advances. We shall discuss advances in concerned with LFAR separately in the upcoming slides. Moving towards liability side. Liability side consists of deposits, which is either fixed deposit, recurring deposits, or a current account open with the bank, sundry payables, provisions, and contingent liabilities. Moving towards the profit and loss account. So in profit and loss account, again, we have a detailed questionnaire in regards how the income and expense have been checked by the auditor. Is there any discrepancy? Then whether the auditor has recalculated the interest calculations, and many more. Moving towards the general information in LF, Annexure number 2, that is in regards in case the bank is having securities of the borrower, whether the custody of the security like gold, bullion is held by joint custody of 2 or more branch heads, whether books and proper records are maintained by the branch, whether there are any fraud cases which are reported against the branch or by the branch, and so on. So let us now move on advances in regards to LFAR. So the auditor has to provide critical comments based on the review of large advances which we have covered above and other advances on a test check basis so that he can provide his comments in respect to paragraphs of long form audit report. The auditor is also required to submit the list of all the accounts which are examined by him for the audit period. Other details to be given in LFAR are as follows, that is credit appraisal, sanctioning and disbursement, documentation, review and monitoring, and supervision. We shall cover each of these in separately detail. So starting with credit appraisal. So we should check whether the compliance of instructions given.
So, so what he's basically essentially explained to us is that LFR is a requirement by RBI. They've released a circular dated 5th September 2020, which needs to be referred by us. As SCA, there is a separate format which we need to produce as LFR, and as an SBA, there is a separate format completely which deals with those four areas that he has mentioned: assets, liabilities, P&L items, and general items. In assets at branch level, generally you won't get to see much about investments, you won't get to see much about cash and balance with RBI and all those things. It will be more focusing on, as I mentioned, fixed assets and advances, and to some extent other assets. So those will be your focus areas. Now, when you start your branch audit at the beginning, you please keep in mind that at the end you also have to submit LFR, and it's a very time crunched assignment. You get just hardly 10 or 12 days where you have to finish the entire audit and issue your all the returns and all the LFRs also. So your LFR working should ideally start right at the beginning, right at your planning stage. So when you're sampling out your advances, that is immediately when you should also sample out, see what is the what are the large advances, which are those advances which are categorized as large advances. The definition is very simple. It has to be 10% of the total fund based plus non fund based, or 10 crores, whichever is lower. That has to be considered as those have to be considered as large advances. So that those identifications are something you can do even on the first day itself. And then similarly, when you're checking your documentations, when you're checking your loan files, you can start making note on all these respective areas. So he's now describing the areas which you need to report in your LFR. So credit appraisal is the first one. So go
So
ahead.
the first area is regarding credit appraisal. So we should check whether the compliance of instructions given by the controlling authority regarding processing of loan, renewal of loan, or enhancement of loan facilities are being properly followed or not. Secondly, we should look for the quick mortality cases where the account turns into NPA within 12 months from the date of sanction. If there are any cases, we should report those cases, and what are the measures taken by the branch to identify the cases in the near future. So we should also check the applicable rate of interest, whether it is correctly fed into the core banking solution of the bank. We should check in case of floating or MCLR, that is marginal cost of lending rate, linked with ROI, whether the same is periodically reviewed and whether there are monthly receipts or annually or quarterly receipts. We should check the credit ratings from RBI accredited agencies is properly fed in the system. They can be third party credit ratings like CIBIL and all. Moving towards the next area, that is sanctioning and disbursement. So in sanctioning and disbursement, we can see whether the credit facility is sanctioned beyond the delegated authority, beyond the sanctioning authority. So if such cases is observed, then whether the same cases are reported to the higher authorities, that is either the regional office or the zonal office. Then whether the disbursement is made without complying with the terms of conditions, whether the loan is granted to companies for buyback of shares. Moving towards the third portion regarding documentation. In this context, we will see whether credit facilities which the bank has given are without necessary documents. Either any of the document is missing, we will have to report in LFAR. Whether there is a non-registration of charge or non-obtaining of guarantee in case of credit facility. In case of credit facilities granted against term deposit receipts, whether a lien has been created on term deposit on the financial system. Next, we should be looking after the review, monitoring, and supervision process. So the procedures laid down by the bank for a periodic review of all the advances, including acknowledgement of debts, balance confirmation, whether it is followed by the branch. Details of pending accounts for review and renewal shall be given in LFAR. Whether in case of large advances, in case of cash credits, scrutiny of stock and book debt statements and other financial data is done by the branch at proper intervals. Whether the drawing power is properly calculated by the branch in case of a cash credit facility. Whether latest audited financial statements of the borrower are obtained for the accounts which are reviewed. If there is any additional facility to be sanctioned for the borrower, we should look for the latest audited financial statement. In case of inspection of securities, whether it is properly being carried out by the branches, whether there is diminution in the security value and is observed in case of securities charged with the bank. Now I have a question for you guys. Is long form audit report a substitute to statutory branch auditors independent audit report. Exactly. Long form audit report is not a substitute. It is a compliance which has to be done as per the norms prescribed by Reserve Bank of India. So now moving towards the next portion of the slide.
So how will you know whether a loan that has been sanctioned, whether it had been sanctioned by the appropriate authority or not? How do you check that?
Sanction letter, the authorities code is delegation
So delegation of power is something that you have to obtain. So this is again generally placed at corporate, I mean at the central level, at the head offices. But then you'll have to ask them that you please give us that document. We need to see the delegation of authority, and based on that only you'll have to ensure that the sanction has been correctly been made or not. So again, all these pointers that he has mentioned over here, this is something you are already checking while you're checking your advances. So be very mindful. The moment you find any discrepancies, immediately start updating that in your LFR also. So that is something you have to do very proactively, right?
So now starting with returns and certificates. Statutory branch auditors are required to sign various returns and certificates apart from their audit report and financial statements of the branch. These returns and certificates are not an additional compliance, just like long form audit report, but they are the prescribed formats with each bank in which different aspects of the bank and banks like general ledger, like balance sheet and profit and loss accounts are covered. As we can see on the screen, there is a illustrative list of returns and illustrative list of certificates. Like in case of returns, there can be GL, that is our balance sheet. It is signed in a particular prescribed format of the bank. Second, the summary of all advances with the bank. Fixed assets containing all additions, deletions, transfer outs of fixed assets. Then it also contains a separate return with it that is regarding depreciation, closed block of depreciation and net block of depreciation. Then the fourth one is regarding claims against the bank, which are not acknowledged as debts. Basically, this is the summation of your contingent liability, which is the part of your Schedule 12, which is a off-balance sheet item again. Now we shall see a illustrative list of certificates. We can have certificates like market mechanism. In case of capital adequacy ratio, we see risk-weighted asset certificate. In case the bank is having a foreign exposure, like basically the borrowers of the bank are having exposure, so we can check whether there is exposure. We have unhedged foreign currency exposure certificate in respect of accounts which are restructured during the period. Again, they are certified in a proper format. So
So to have an understanding on what kind of returns and what are the kind of certificates that you need to certify, the best source is your closing circular. So the first day of your branch audit, you demand the branches that you please give us your closing circular, which has been issued by your head office, and you go through that closing circular. In that closing circular, there is a list of entire returns and certificates which you need to check. And once you get the listing, what you should also do is you should go to RBI website and download those applicable circulars like market mechanism or risk weight. What are the risks that needs to be uh, charged to different categories of advances that you need to know through that you'll come to know through RWA applicable circular. Similarly, UFC has a separate circular. So download all these circulars and then you ensure whether they are being complied with before submitting it to the branch.
yes, so one slight difference between returns and certificate is that returns are signed on the last page of the document, whereas certificates are signed on the each page. That differs from every bank to bank. Basically, returns and certificates are whatever documents the bank are required to get signed by the central auditor or the branch auditor in prescribed formats. So moving towards the next slide is regarding closing and documentation of audit procedures. So uh, an audit is not only required to be done, but it must be evident from the audit documentation, which is being maintained by the auditors at all the time. Audit documentation is required to substantiate that auditor has conducted the audit with performing appropriate audit procedures on test check basis and on the basis of which he has derived his audit opinion. All the documents right from engagement letter, management representation letter to the audit report shall be documented properly. Work papers right from planning stage, covering the execution stage and to the conclusion stage, along with queries raised by the auditors and what responses the bank management or the branch management has replied on shall be properly documented in documentation. The auditor should ensure that he maintains a separate folder regarding all the documents which he has signed. It shall contain all signed returns, certificates, audit reports, long form audit report, and so on. As per I say 230, that is audit documentation, it requires that auditor to duly prepare and maintain audit documentation for audit of financial statement. Bank is no exception to this. Now let us move towards the last slide of
Just
our
one thing
presentation.
I wanted to add here. So, ICI comes with a guidance note every year. So before you start your bank audits, please obtain a copy of that latest available guidance note. There you'll have proformas of all kinds of letters that you need to issue, or that you need to communications that you need to do with the banks or the branches, right from your audit report format to your engagement letter format that you need to sign and submit to the bank, the MRL that you need to avail from the branches. All those formats are mentioned. Of course, MRL points will differ based on your observations, based on whatever pointers are critical and applicable to your branches. But the basic formats have been mentioned, have been given in that guidance note. Also, for LFR, there is a separate technical guide. So download that technical guide also. It's a separate guide which is not included in your guidance note. So that also you can download and refer when you're filling in your LFARs.
Now moving towards the last part of our presentation, that is what key takeaways can we take from this session. So basically we started with the overview of the branch audit. What is a branch? How it is different from a bank? That is a corporate level. So we focused on key concepts like what are NPA, what are asset classification, what are AREC norms. Then we move towards NPA and compliance check, understanding what are the asset classification and how differently it can be done. Then we move towards long form audit report and reporting portion. Then at the end, we covered how actual audit is to be performed in a bank branch audit. So uh, feel free to ask any kind of queries if you have got throughout the sessions.
So you have any questions, anything in particular you want to discuss? Comment box also we can see.
Comment box.
Can you please repeat the concept of LC and BG? You want to repeat once?
So it is one which is preferable facility for an export, LC or BG.
So we have a question in the chat box that which is preferable facility for an exporter, LC or BG? Uh, in my opinion, the letter of credit would be more safer because it guarantees the payment as long as exporter follows the guidelines or submits the document like I have explained, bill of lading or invoice for the shipment.
Difference between LC and BG.
Okay. So the difference between LC and BG is as so the difference between LC and BG is bank pays first because bank guarantees the payment to the seller after verifying the documents like invoice and bill of lading for the order. And on the other hand, in case of BG, bank pays only if the buyer defaults. That's the main difference between LC and BG.
Yes, you will be provided with the PPT for future reference. Do we have Excel tools for determining NPA? So generally, we when we are conducting our audits at branch levels, we generally use the basic functions of which are available with in Excel. I think that they are sufficient. Like VLOOKUPs and then there is this pivot table. All those basic facilities of Excel is what we use. Do you all use anything else, any other software or anything that any other tools? No, so typically it suffices, right? I mean, it is sufficient. Where can we find PPT? It will be shared by the coordinators over here from BCS. So don't worry about that. If as long as you are registered with the, I mean, you've given your details of numbers and your email IDs with them. Right. Okay. Anything you all want to add, or anything you think that with what you do in terms of advances, uh, verification, or in LFAR, or in your return certificates, anything that you additionally do that you would want to highlight? Something that comes to your mind? Okay, so how do you know, you know the concept of consortium banking? Suna hai? How is it different from multiple banking? Any idea? So you know so what is consortium banking?
Multiple banks,
So for a borrower, multiple banks they come together and they give a facility. So and then it is being monitored by a lead bank. That is consortium lending. And what happens in case of multiple banking? Separately. So it'll be treated as separate facilities. So all the multiple banks will have their own set of documentation. So consortium lending is more from documentary point of view. It makes convenience. Yeah, is the leader. Correct. So that is something you'll have to keep in mind. Then why do some banks consider 20% for secured substandard asset? So they have to comply with the basic norms that have been given by RBI, but if they choose to have higher percentage, that is allowed in case of NPA accounts, especially. That can be done. This is something we had already discussed. So there's someone who's asking, why do some banks consider 20% for secured substandard assets? So they can have higher provisions if required. Thank you so much, everybody, for joining in. I hope this does benefit each one of you. In case you have any queries, any doubts, you can please contact Paras from BCS. He will help you out with that. Thank you so much.